The copper wall crisis. How AI infrastructure is creating new millionaires. There is not enough copper on Earth to support the AI boom that Wall Street is pricing in right now. Let me say that again. The artificial intelligence revolution, the data centers, the chips, the power grids, is running into a physical wall, a copper wall. And while most investors are still buying AI software stocks at 35x earnings, the real money in 2026 is quietly moving underground, into mines, into infrastructure, into real-world assets. Because here's the shift. Speculative growth made millionaires in 2021. Hard assets are making them in 2026. And if you don't understand this rotation, you're positioned for yesterday's trade. Today, we break down how the AI infrastructure boom is creating a new class of millionaires and how you can position yourself before the supply shock fully hits. The problem / the opportunity. AI isn't just software. It's physical. Massive server farms, high-voltage transmission lines, cooling systems, power substations. Every layer requires copper. Now combine that with Federal Reserve rates stabilizing around 4.5%, infrastructure reshoring across the US and Europe, a government's prioritizing energy independence, corporations building AI data centers at record pace. This is not speculative demand. This is structural demand. Yet here's the gap. The average investor is overweight AI chip designers, overpaying for mega-cap tech, ignoring supply chain bottlenecks. Meanwhile, institutional capital is accumulating. Copper producers, a grid infrastructure companies, industrial metals ETFs, engineering and construction firms. The top 1% understand something simple. AI runs on electricity. Electricity runs on copper. And copper supply cannot scale quickly. Permitting takes 7 to 10 years. New discoveries are declining. Ore grades are falling. This is not a hype cycle. It's a supply constraint cycle, which means opportunity. Let's break down how to position correctly. Pillar 1, copper mining majors supply leverage play. When supply is constrained and demand accelerates, producers gain pricing power. Copper is already critical for data centers, EV charging networks, grid modernization, renewable infrastructure. But AI multiplies this demand. Each advanced data center consumes thousands of tons of copper in wiring, transformers, and cooling systems. And supply? Tight. Now, instead of speculating on junior miners with no revenue, focus on established global producers like Freeport-McMoRan, BHP Group, Rio Tinto. These companies offer direct exposure to copper pricing, dividend payouts, operational scale, strong balance sheets. Why this works? Technical breakdown. From a portfolio diversification standpoint, copper miners add commodity exposure. Commodities often act as inflation hedges. In a higher rate environment, tangible asset producers tend to outperform speculative growth. And here's the leverage effect. If copper prices rise 15%, mining company margins often expand disproportionately, because fixed costs remain relatively stable while selling prices increase. That's operating leverage. Hypothetical example. Let's say you invest $1,000 into a diversified copper producer. Dividend yield, 3%. Annual dividend, $30. Now assume copper prices rise 20% over 2 years due to AI infrastructure demand. If the stock appreciates proportionally, your $1,000 becomes $1,200. Reinvest dividends during that time. Now, your total value might reach $1,250 to $1,300 depending on compounding. That's a 25 to 30% gain in a relatively short cycle. Not guaranteed, but structurally supported. And remember, this isn't speculative demand. It's infrastructure demand. But here's the catch. Copper producers benefit from price increases. However, there's another layer of the AI build-out that Wall Street is underpricing completely. The companies that build the electrical backbone, transmission, grid expansion, power conversion. Because without grid capacity, AI doesn't scale. Pillar 2, electrical grid and power infrastructure companies. The hidden bottleneck trade. Everyone is talking about AI chips. Almost no one is talking about transformers. And that's the problem. Because AI data centers don't just need semiconductors. They need high-voltage transmission lines, substations, transformers, switchgear systems, cooling infrastructure. And here's the bottleneck. Transformer lead times in 2026? Still stretched? Grid modernization projects? Backlogged. Utilities are racing to upgrade infrastructure to handle AI-driven electricity demand. This is where the second wave of wealth creation is happening. Who benefits? Engineering and grid infrastructure leaders like Quanta Services, Eaton Corporation, Schneider Electric. These companies provide electrical equipment, a grid automation, power management systems, data center electrical architecture. And they don't rely on hype. They rely on contracts, multi-year contracts, backlog-driven revenue. Why this matters for asset allocation. This isn't pure commodity exposure like copper. This is industrial infrastructure exposure. From a portfolio construction standpoint, this adds revenue visibility, earnings stability, lower commodity price sensitivity. It diversifies your exposure within the AI theme, because remember, diversification doesn't mean owning random assets. It means owning different profit drivers. Copper profits from pricing. Grid companies profit from installation and engineering contracts. Different risk vectors. Same macro tailwind. Hypothetical example. You invest $1,000 into a diversified power infrastructure company. Dividend yield 2%. Annual dividend $20. But earnings are growing at 12% annually due to backlog expansion. If the stock compounds at 12% annually for 5 years, your $1,000 becomes roughly $1,762. Add reinvested dividends, closer to $1,850 plus. This is growth powered by infrastructure necessity, not narrative. And here's the bridge. Copper supplies the material. Grid companies build the backbone. But what about the ultimate driver? Electricity itself. Because AI doesn't run on silicon, it runs on power. And that leads us to Pillar 3. Pillar 3, energy producers and data center power plays. The electricity multiplier effect. Data centers are projected to consume a significantly larger percentage of U.S. electricity by the end of the decade. AI workloads are exponentially more energy intensive than traditional computing. That means more baseload power, more natural gas generation, more nuclear restarts, more renewable integration. Energy demand is rising structurally, and energy producers with stable cash flow are positioned to benefit. Companies such as NextEra Energy, Constellation Energy, these firms are deeply involved in grid-scale energy generation, nuclear and renewable expansion, utility-scale power supply contracts. Why does this matter? Because AI infrastructure requires reliable, scalable electricity, and power purchase agreements, PPAs, create predictable revenue streams. Portfolio diversification angle. Energy utilities provide dividend yield, lower volatility compared to tech stocks, defensive characteristics during downturns. This reduces overall portfolio beta. When speculative AI stocks drop 25%, utilities may decline far less, sometimes even rise during defensive rotations. That smooths performance. And smoother performance improves compounding over time. Because avoiding large drawdowns matters more than chasing maximum upside. Hypothetical scenario. You invest $1,000 into a utility with dividend yield 3.5%, earnings growth 6 to 8% annually. Year 1, $35 in dividends. Assume 7% annual appreciation plus dividend reinvestment. In 10 years, your $1,000 could grow to approximately $2,000. That's doubling capital through stable yield, moderate growth, a long-term compounding, not speculation, infrastructure-driven demand. The bigger picture. Let's zoom out. Copper miners capture material pricing upside. Grid infrastructure firms capture installation and modernization revenue. Energy utilities capture electricity demand growth. Three different engines, one macro force. AI infrastructure. But here's the question. What happens if copper prices spike too fast? What if demand slows? What if policy shifts impact energy subsidies? This is where most investors get blindsided because they build thematic exposure without building risk controls. Pillar 4, the financial layer, copper and infrastructure ETFs. The diversified exposure strategy. Now, let's talk about the layer most investors skip. They buy a single miner or one infrastructure stock, and they call it diversification. That's not diversification. That's concentration with hope. If the thesis is AI infrastructure creates a copper bottleneck, then a diversified vehicle can reduce single company risk. Instead of betting on one management team, one mine, or one contract pipeline, you spread exposure across the entire value chain. ETFs that provide this thematic exposure include Global X Copper Miners ETF, iShares US Infrastructure ETF. These funds offer broad exposure to copper producers, infrastructure contractors, engineering firms, materials suppliers. Why? This strengthens asset allocation. From a portfolio construction standpoint, ETFs reduce idiosyncratic risk. If one mining company faces operational setbacks, the ETF absorbs the shock. If one infrastructure firm misses earnings, the broader basket stabilizes returns. This improves risk-adjusted performance, and risk-adjusted performance determines long-term wealth creation, not short-term spikes. Hypothetical example, let's say you allocate $1,000 into a diversified copper mining ETF. Assume average annual return 9%, dividend yield 2%, reinvestment enabled. After 10 years, that $1,000 compounds to approximately $2,367. Now compare that to a single stock that experiences a 40% drawdown due to operational issues. Diversification protects compounding, because compounding requires survival, and survival requires structure. Risk management. The AI infrastructure reality check. Let's reset expectations. Copper is cyclical. Infrastructure spending can slow. Energy prices fluctuate. This strategy is not immune to volatility. The difference is preparation. Margin of safety in 2026. Margin of safety today means avoiding over-leveraged miners, avoiding companies with unstable dividend payouts, avoiding thematic hype without cash flow. It also means position sizing. No single pillar should dominate your allocation. A balanced structure might look like 30% copper and materials, 25% grid and infrastructure, 25% energy utilities, 20% defensive cash/short-term bonds. That last category matters. Liquidity gives you optionality. Optionality gives you power. Black swan scenarios. Let's talk about what could break this thesis, because ignoring risk is how retail investors lose money. 1. AI demand slows. If AI investment overbuilds capacity and demand slows, copper prices correct. Miners retrace. Infrastructure firms see backlog compression. 2. Regulatory delays. Environmental permitting slows new projects. Mining expansion stalls. Grid upgrades face policy gridlock. Capital gets delayed. 3. Global recession. Industrial demand contracts. Commodity prices fall sharply. Energy consumption softens temporarily. 4. Technological substitution. A breakthrough reduces copper dependency in transmission systems. Unlikely short-term, but not impossible long-term. Smart investors assign probability. They don't assume certainty. 2026 outlook. Why the trend still favors hard asset. We are in a higher rate world. Capital is no longer free. Profitability matters. Cash flow matters. Real-world assets matter. AI is not just software. It is physical infrastructure. and physical infrastructure cannot scale without materials and power. The copper wall is not a meme. It's a bottleneck, and bottlenecks create pricing power. Pricing power creates margin expansion. Margin expansion creates shareholder returns. That is the chain reaction. The 3 key takeaways. Let's simplify everything. 1. AI is a physical story. If you only own software stocks, you're missing half the trade. Copper, grid infrastructure, and energy are the real enablers. 2. Diversification within the theme is critical. Miners, infrastructure firms, utilities, ETFs, different profit drivers, same macro force. 3. Structure beats speculation. Position sizing, liquidity, margin of safety. That's how you turn a macro theme into sustainable wealth. Exact next steps. Here's what to do immediately. Step 1. Review your portfolio. Do you have zero exposure to materials or infrastructure? If yes, you are underpositioned for the AI build-out. Step 2. Decide your allocation split. Individual stocks for higher conviction. ETFs for diversification. Utilities for stability. Step 3. Automate reinvestment. Compounding only works if you let it. Step 4. Monitor copper pricing trends quarterly, not daily. This is a structural story, not a day trade. If you want to see how I personally structure an AI infrastructure allocation model, click the link in the description and download the AI infrastructure portfolio blueprint. It breaks down allocation percentages, compounding projections, and risk controls. Stop chasing headlines. Start positioning for structural demand. And if this breakdown gave you clarity, subscribe. Because we focus on real capital flows, not hype cycles. Comment question. Now, I want your honest answer. Do you believe AI will hit a supply bottleneck, or do you think technology will innovate around it? Drop your perspective below, because the biggest gains in history came from understanding bottlenecks before everyone else did.